So for 19, it states Deferring Inc. sold $150,000 in inventory to Schilling Company during 2014 for $225,000. Schilling resold $105,000 of this merchandise in 2014, with the remainder to be disposed of in 2015. Assuming that Deferring owns 25% of Schilling and applies the equity method, what journal entry is recorded at the end of 2014 to defer the unrealized gross profit? So the first thing we need to do is figure out what the gross margin is. Okay?
Yeah.
So the first thing we'll do is the ending inventory is they purchased 225. Okay, let's first look at the gross rate. They sold it for 225. They bought it for 150, which means they made $75,000 on $225,000. So 75,000 divided by 225,000 is, come on, equals 75.
About 33%.
You are, oh God, 33%, you rock. So we know the gross profit rate is 33%. That's the first thing we have to do. The second thing we have to do is to determine how much of this we need to defer.
Okay.
So they tell us that the ending inventory is the difference between
What they sold.
the 225 minus the 105.
For the reseller, should say.
So 120 is left over, right?
Right.
So they have ending inventory of the 225 minus the 105, so of 120. We know the gross profit rate is 33%. So the unrealized gross profit is $39,600. How come I don't have that? I guess it should be 33 and a third.
Yeah.
So
More like 40,000, right? I guess that would make sense.
yes, 40,000. So now, how much of this company do they own? They own
It doesn't say.
25%.
Oh, okay.
They own 25%.
Schilling. Yeah.
So 25% of that 40,000 is, so investors' share of ownership is 25%, and their portion of this income that's deferred is $10,000. Okay? So what they would have to do, because they need to defer this income, okay?
Okay.
They need to debit, so the entry to defer unrealized gross profit is to debit equity income from Schilling of 10, and will credit investment in Schilling for 10. Okay? Because that portion we need to reduce from any earnings. Because think about it, the income is going to include all that.
Right. Yeah.
And that income is a debit to investment in shilling and a credit to equity income. So we need to defer that portion.
Because it wasn't earned.
Earned yet, yes. Now, 32. So this number 32 will pretty much be detailed.
Yes.
So, on January 1st, 2013, Plano Company acquired 8% or 16,000 shares of the outstanding voting shares of the Sumter Company for $192,000, an amount equal to Sumter's underlying book and fair values. So there's nothing excess. Sumter declares and pays a cash dividend to its stockholders each year of $100,000 on September 15th. Sumter reported net income of $300,000 in 2013, $360,000 in 2014, $415,000, and $380,000 in 16. Each income figure can be assumed to have been earned evenly throughout the years. In addition, the fair value of these 16,000 shares was indeterminate, and therefore the investment account remained at cost. So we just recorded our investment initially just at the cost we bought it for. That's it. On January 15th, so 2 years later, Plano purchased an additional 32% of Sumter for $965,750 and began using the equity method.
And because now they have a significant investment.
We have to go back and readjust retroactively.
2 years.
This price represented a $50,550 payment in excess of the book value of Sumter's underlying net assets. Plano's willing to make this extra payment because of the recently developed patent held by Sumter with a 15-year remaining life. All other assets were considered appropriately valued by Sumter's books. On July 1st, 2016, Plano sold 10% of Sumter's outstanding shares for $425,000 in cash. Although it sold the interest, Plano still maintains the ability to significantly influence Sumter's decision-making process. So we have to prepare journal entries for all this stuff. So let's make it easy. We have to start with January 1st of 2013. They purchased the shares for $192,000. So the first thing we are going to do, whoops. First thing we're going to do is show that investment. So on 1/1/2013, we are going to show an investment in Sumter for $192,000. and we're going to show cash or a liability for $192,000, and we're going to say to record the cost of 16,000 shares of Sumter Company. Easy. Now, because they only own 10%, excuse me. Because they only own 10%, we're going to use the cost method. So we need to only show the dividends that they received. So in 2013, they paid cash dividends of $100,000. So 10% of that is $10,000. No. Do they own 10%?
Oh. 8%.
8%. Okay. So on 9/15/13, we're going to need to show cash of 8 and dividend income of 8. Okay? Annual dividends declared and received from Sumter because declaration and payment are on the same day. We no need for a receivable, okay? Now, in 2014, they also received a dividend each year, 100,000. So in 2014, 9/15, we'll also have cash of 8 and dividend income of 8. Okay? Now, 2015 hits us like a ton of bricks. Plano purchased an additional 32% or 64,000 shares of Sumter for $965,750 cash and began using the equity method. The first thing we need to do is to record that purchase. 0101. So we'll debit January 1st, 2015. So we'll debit investment in Sumter for $965,750, and we'll credit our cash or our liability $965,750 to record the cost of 64,000 additional shares of Sumter. Now, we're going to need to figure out how to retroactively adjust these, right?
Right.
So, what we'll do is let's just create a little grouping of what we did do and what we need to adjust it to. So what we did do originally in 2013, we showed income of $8,000, okay? In 2014, we showed $8,000 also of income. Now this is how we need to retroactively state it, is now we need to do equity method. If we did the equity method to start out with, what we would have to do is take a percent of their revenues. So their income for the period was $300,000
Right,
and 8%. So we would have to do income share of $24,000, and then we would also reduce our dividends by 8. So we'd ultimately have a difference here of 16. Okay? And here we're reporting 8. Okay?
Right.
Now in 2014, under the equity method, we would show 8% of our income, which was 360.
Yeah.
So we would show 8% of that income to be 28.8. Reduce the dividends by 8. And we should have new income, difference of 20,800, right?
Yep.
So, really, we need to adjust our investment account by 16,000 and by 20,000. So, 36,800 needs to be adjusted, and we need to show a journal entry to add that to our investment, right?
Yep.
So we are going to go back here on this day, January 1st, 2015, okay? January 1st, 2000. And we're going to debit investment in Sumter for 36.8, and we're going to credit a retained earnings prior period adjustment of 36.8. And that's basically adjusting our books. Instead of just claiming those dividends, now we need to go and perform it in the equity method fashion. Now, it tells us in 2015, the earnings were 400,000, right? And now we own 40%. So 400,000 times 40% is 160,000. Excuse me, the one thing we do need to do first is prior to that, on September 15th of each year, they give them a dividend.
Right.
So we need to do that first, since that comes first. So September 15th, 2015, we're going to show cash of 40, and we'll credit our investment in Sumter, won't we?
Yes. Yep.
Then we're going to show the portion of income which is investment in Sumter of 160,000, and then equity in Sumter, 160,000. Okay, because that's based on 40%. Now, when they purchased this additional 32%, 50,550 of it was excess due to an asset. So 50,550 is a patent that is going to be amortized over 15 years. Okay? So we need to take into account this patent. So this patent of 50,550 over 15 years needs to be amortized in the books. Okay, so on December 31st, 2015, we're going to need to debit equity in Sumter for basically $3,370, and we're going to credit our investment in Sumter for $3,370 also. Okay? Now in 2016, we sell it. We sold it in the very middle of the year. On July 1st, 2016. We sold it for $425,000 cash. But before we sell it, we're going to need to accrue our investment and accrue the patent piece. Okay, so we know exactly what our asset has, so we can show any gain or loss. So we're going to want to show that we had in 2016 $380,000 of income. Now we're going to show that income on July 1st, 2015. We're going to debit our investment in Sumter of basically the $380,000 times 40% in only half the year, because it told us that all the income happened equally. So if we take the $380,000 of income times 40% times only half the year, 76,000, and we credit our equity in Sumter also of 76,000. Now, you know this patent we just out amortized of $3,370, we can only amortize half of that. July 1st, 2015, equity in Sumter, half of $3,370 is $1,685, and we'll credit our investment in Sumter, $1,685. So we need to go and really see what do we have in Sumter. Okay?
Right.
So I'm just going to go and have a column here, investment in Sumter. Let's go and look at our transactions. We had 192 here, right?
Yeah.
192 plus 965,750. So 192, that was the initial investment, plus 965,750. Then we had to go and do that retroactive adjustment of 36.8. See that? When we had to treat, yes. Okay, so we add that. Then we can subtract out our dividends, right? Then we go back here. Each one of these will add our investment on December 31st, 2015 of 160. That was a debit. But we also have a credit on the same day for our patent allocation, 3370. Then on July 1st, we allocated our income and also subtracted out our allocation on the patent. So we should have, I have it wrong, 192, 965, 36.8 minus 40 plus 160.
160, there it is, yeah.
$1,385,425, but we're only selling 25%. Okay? Because it says here, we sold
10%, right? On July. Am I confused here?
we sold 10% of Sumter's outstanding shares,
Okay.
but we own 40%.
Cents still. Okay.
So
okay.
in our books, this figure, 25% of it we're selling.
Okay.
You're right, it's only 10% of all of Sumter,
Right.
but it's 25% of what we have.
What we have.
So 25% of this should be $346,374 is our cost basis. Does that make sense? So we will show the sale on July 1st, 2016. We'll show we received in cash $425. We will get rid of our investment in Sumter by crediting it, $346,374. And the difference would be either a gain or loss. Gain on sale of investment. So this would be a result of that minus that. 78,626 is our gain. So we're recording to record the sale of 20,000 shares of Sumter Company. Now, we now have 30% ownership left. So on September 15th of 2016, when they declare dividends, we will then show 30% cash of 30,000, and we'll credit our investment in Sumter for 30. Then, when we show the income, we're going to show the income in 2016 was 380. We now own 30%, but we're only going to take it for 1/2 a year, because remember how we accrued it up until July?
Okay.
So we're going to take 380,000 now times 30% times half a year. And that amount would be, as of December 31st, 2016, we would show investment in Sumter of 57,000, which is 380 times 50% times 30%. And we would show equity in Sumter, 57,000. Then we would need to record our patent piece also. So to record a portion of the patent amortization, half of the year would be $1,264 again. We would say equity in Sumter of $1,264, and we would credit our investment in Sumter, $1,264. That, in a nutshell, really goes through how we allocate the purchase price, then how we, if we increase our percentage, how we have to retroactively state it, and then when we sell a percent, how we have to calculate that piece too. It does it all.
Wow.
And that is about